This house in Marysville, Washington is listed at $475,000, and I'm going to walk through a real mortgage quote to talk about what it would be like to buy this house if you have $60,000 saved up for the down payment. So I'm going to walk through two different quotes. Actually, I'm going to show you one scenario where you're actually able to use all of that cash and show you what your monthly payment might look like and also how much income it would take to qualify for that loan. And then I'll also walk through one where you're putting more of a minimum down payment, a much smaller down payment than using that whole $60,000, and I'll show you the impact of that on your monthly payment and also on how much income it would take to qualify for the loan in that scenario. Now I'll walk through the numbers and hopefully just give you some reliable numbers, a little bit more reliable than what you might find in an online calculator like Zillow, for example. And then I'll also give you a little bit of an explanation behind the numbers because this is obviously a very complicated process. And so hopefully getting a little bit of information behind why the numbers are what they are, how they change, what impacts them. Hopefully that will be helpful along the way as well, and you'll be able to come into the mortgage process and have a better sense of what to expect and how to evaluate your options and what to look for in a loan officer and a lender and all of that. And just so you know what you're looking at, this is a real mortgage quote. My name is Landon Buto. I work with Cleveland Street Mortgage based in Bothell, Washington, and this is a real quote that we pull on this house. So these are good numbers to expect and good information here. That doesn't mean it's the exact numbers that you're going to get. It doesn't mean it's an advertisement for the exact rate that you can expect, but it should be a reliable sense of what to expect and the details behind it as well. So let's go ahead and look at the quote. So here on the left is the 3% down scenario, and here on the right is a 10% down scenario. So in this one on the right, we're going to use pretty much all the cash. You'll see we'll use pretty much all the cash that you have saved up, that $60,000. And then on the left, we'll just use 3% down and then any closing costs, and I'll show you how much cash that means all in. Before we start looking at the numbers themselves, I should tell you that in order to create this quote, I had to assume a specific credit score. So I'm using a 740 credit score, which your credit score will impact your pricing. But if you're relatively close to this, it won't be drastically different. But just know that this is created using a 740 credit score as an assumption. So let's go ahead and look at the numbers. Let's walk through the 10% down first. And also it's helpful to know about your options, not just the exact scenario in isolation. Even if you end up going with something like 10% down, it's helpful to know why you're doing that versus something like 3% down or 20% down or all the impacts of that. So we're just going to compare to that 3% down in a second. But let's walk through the 10% down first and then we'll compare. So the 10% down, the monthly payment is $3,415. And that has four main components. The first component that I'm going to point out here is homeowners insurance of $150 per month. Now again, the list price, the purchase price is $475,000. And so that's going to be a big impactful feature of determining your homeowner's insurance. And so $150 per month is a pretty good estimate for where your homeowner's insurance will be in this area at this price point. However, that is going to vary a lot. That is just an estimate. And it is going to vary a lot depending on who your provider is and what your coverage is. If you're getting a lot coverage, it's going to be more expensive. If you're getting less coverage, it's going to be less expensive. And then obviously just on who your insurance provider is. So that is an estimate, but it should give you a pretty good idea of what to expect, at least in this area. And then this component right here is taxes, real estate taxes, $238 per month. And that's pretty relatively low for this general area, for this county. But that is drawn, that's not an estimate, that is the actual number for 2024, drawn from the county website. They post the public tax information there. So $238 per month in taxes. And then we have $75 a month in mortgage insurance. Now this is where it's going to be interesting to compare that to the 3% down scenario. But mortgage insurance, if you're not familiar, is just a cost you have to pay if you put less than 20% down. Because if you're putting less than 20% down, the lender is incurring significant risk of the possibility that you default on that loan. And if you default on that loan, they have to bear that. And so it protects them from some of that risk. And so that's a universal requirement. If you put less than 20% down, you will need to pay mortgage insurance. But how much that mortgage insurance is will vary a lot. Obviously, $75 a month is a significant number. It's It's not nothing, but it's helpful to know that this number could be a lot more. It could be closer to $200 or $300, depending on several factors. One of those is your credit score, and then another factor is your down payment percentage, and then another factor is just the loan amount. If you have a very big loan amount, the cost to protect the lender against the risk of defaulting on that loan is going to be higher. So $75 a month of mortgage insurance in this scenario. If we had a higher credit score, we might be able to knock that down some. If we got a higher down payment percentage, if you got to 15%, typically 15% is an important threshold that you can get to in order to knock down your mortgage insurance significantly. But 10% is great, and that is much lower than it could be, and we'll see that in just a minute. And then the last component is principal and interest, which is $2,953. And your principal and interest is just a function of your loan amount, which is $427,500, and your interest rate of 7.375, and it is amortized over 30 years. It's a 30-year loan. So interest rate of 7.375. This is I'm filming this video on April 19th, and that is what we're showing for this particular borrower profile, this particular scenario right now, and it's pretty close to the 30-year conventional average right now. That's just where we're at. It's up from where interest rates have been the last several weeks, and no one really knows what some people obviously have opinions on what to expect going forward. We generally expect rate cuts at some point this year from the Fed, but don't really know when to expect those. We would love it if this was the peak and if we started to see those come down, but we just don't know. So 7.375, again, that's not an advertisement for a rate that is necessarily available to you. It's just an estimate of where we're at based on this borrower profile right now. This section is just saying, you can see here, it says monthly payment of $3,027, and that's a little confusing because the total payment up here is $3,415. But it's just saying basically from the lender's perspective, the mortgage perspective, excluding your taxes and your insurance, because that's not affected by your loan. What is your monthly payment? So principal, interest, and mortgage insurance added together are $3,027. Points or credit, I'm not going to get into detail in this video on why those are not zero. Basically, just so you know what they are, points is a fee you can pay up front to the lender to get a lower interest rate. You lock in a lower interest rate by paying some cash up front. Credit is the reverse of that, where the lender credits towards some cash towards your closing costs if you take a higher interest rate. So you get some of your costs covered, some of your cash saved, and you pay a little bit more over the long run. That's what credit is. And so this is showing that we're paying points of $300. Just know, I'm not going to get into why right now, but just know that is basically zero. Obviously, $300 is not zero. You're paying that up front with your closing costs, and that is a real cost. But it's very close to zero relative to what points could be. This could be several thousands of dollars, and it takes several thousands of dollars to impact your interest rate at all at this price point, or at this loan amount at least. So just know that yes, this is $300, but it's not like that $300 is moving the needle on your interest rate. And so I'll leave it there. Lock period of 30 days. You have to lock your interest rate at some point along the process of getting your loan. Typically, it's after you get into contract on a house, you lock your interest rate, and that's the interest rate you get going into the loan. But you can lock it for 30 days, you can lock it for 60 days, 45 days, 90 days, and there are various lock periods, and so that's what this is showing here. 30 days is pretty typical. No prepayment penalty, no penalty for paying off this loan early. Lender fees of $1,195. That is going directly to the lender. We are a mortgage broker. We broker to various lenders. That tends to be a really great way to provide great options to borrowers, and also it tends to be very price competitive compared to retail options a lot of times. So this is going directly to the lender, which is, in this case for this quote that I'm using, is United Wholesale Mortgage. Again, this is just an estimate, but just keep an eye out for that number. Make sure it doesn't get super high. If you see several $1,000s there, maybe ask your loan officer about it, or start to look into it a little bit. It's pretty typical to at least see a little bit to cover the services involved in getting you the loan. So other closing costs of $10,106. Every time you go to get a loan, you have to pay more than just your down payment. That's something sometimes people don't realize when coming to get a house. You think about the down payment and you know you need to get that together, but you also have to pay costs to people involved in helping you get the loan and various fees there, and helping you get the house. So there's two main buckets of closing costs. There's two main groups that go into that. There's one component that is really the fees and the costs involved in helping you get the house. You have to pay for your appraisal, for your inspection. You have to pay the title and the escrow company, things like that. You have to pay the actual costs to people who are helping you make it happen, various fees involved in that. And then the other main component is you have to pay what's called prepaids. And prepaids are costs that you're going to be paying on an ongoing basis as part of your mortgage on an ongoing basis, but you have to get some of them into escrow ahead of time because you need to start making payments on certain things for the first month or so that you won't be set up in time, that won't be covered by your first mortgage payment. Typically, your first mortgage payment doesn't happen for over a month after you get into the house, and so that first month of expenses needs to be taken care of. That's the shortest way to describe it. So that's kind of what's involved in closing costs, those two main components. And so we're seeing $10,106 in this scenario, and for this price point and for this loan amount, that is a pretty good number to expect. It will depend on several things, but if you start to get into a higher purchase price or a higher loan amount, right now $10,000 to $12,000 in this realm is probably a good expectation. If you start to get into a higher purchase price or higher loan amount, you might expect more like $12,000 to $15,000. It depends on several things, but if you're just estimating ahead of time and kind of making mental calculations, this price point, this purchase price would be something like $10,000 to $12,000 likely. So what that means is if you add your closing costs to any other to your down payment, you add your closing costs with your down payment of 10%, which is something like $47,500 in this scenario, plus your other closing costs. Altogether is going to be $59,104. That's how much cash you're going to need to bring to put into escrow to make this deal happen, to get the house, and then to start making your payments there. So $59,000, $60,000. That's where that $60,000 goes. So just be mindful that it's not all going to go to your down payment. In this scenario, you have $60,000 coming in. How much income are you going to need to be making in order to qualify for this loan? How much income will the lender need to see that you are making in order to approve you for this loan? We'll talk about that in 1 second. Just for your reference, I want to go back through and talk about the 3% down scenario and show you how the numbers change. I won't go into a ton of detail here, but I just want to give you a sense of what difference it makes to get to 10% down versus 3% down. Obviously, your loan amount will go down, but there are some other things that are impacted. Homeowners insurance and taxes will not be impacted because those are just based on the house. They're not based on the loan amount, the loan structure, anything like that. So those stay the same, $150 and $238. However, mortgage insurance changes, and this is an important change because it is directly a change in costs. It's, yes, of course your monthly payment is going to change because you have a different loan amount, and you have a larger loan amount to repay, and you're paying interest on a larger loan amount. So obviously that's going to change, but it's also important to recognize which of those changes in your monthly payment are just from increased costs. Now, and I forgot to mention the number, it's $3,708 instead of $3,415. And some of that change is coming from your increased cost of mortgage insurance, because since you're 3% down instead of 10% down, two things. One, that means you have a larger loan amount, and two, you just showing that you are 3% down rather than 10% down puts you into a larger risk category, which means your cost to cover your risk, which is your mortgage insurance, will be higher. So we're at $138 per month rather than $75 per month of mortgage insurance. And then the last component is just principal and interest of $3,182. Again, same interest rate in this situation. The cost to get to that interest rate is even pretty much the same, $300 here. And so getting from 3% down to 10% down in this loan program, in this market, did not change your interest rate. Sometimes it will. Going from 3 to 10% down will change your interest rate. But specifically what it did change is your mortgage insurance. So mortgage insurance changed, interest rate stayed the same, and closing costs, again, pretty much the same. Even though the loan amount is slightly higher, it's really not big enough of a difference to have an impact on your closing costs. So closing costs are pretty much the same. And so now the estimated cash to close is $25,965. So maybe there's a scenario where you can look at these two and you can say, well, the only increased cost I'm paying is not even quite $75 a month of difference in mortgage insurance. Yes, my monthly payment is higher, but I'm okay with that higher monthly payment, and I'd rather have the cash in my bank account right now. So if you're comparing your options, anytime you go to get a loan, you should recognize what your options are. You should quantify the difference. Okay, it's a difference of $300 a month in monthly payment, but in terms of cost, it's just maybe $75 a month in mortgage insurance and a little bit more in interest paid. So that's yes, you are paying a little bit more in interest, but if you're only having this loan for maybe 10 years before you either move or refinance, probably less than that. The interest paid is not going to have a massive difference, and it's only about $75 a month difference in mortgage insurance, which is not nothing. If that may be the difference maker. And then, of course, it's a $300 a month difference in monthly payment, but that's not all costs. Some of that is just you have a larger loan amount to repay. So evaluate that difference. If you have the luxury to put 10% down, obviously you're saving money. But if that's going to stretch you cash-wise and you'd rather have some of that in your bank account when you move in, and this isn't much of a problem for you, the difference here between the monthly payments isn't much of a problem for you, that's important to keep in mind. So here's the other important piece to keep in mind is what does this do to your qualifying ability? Because here it's going to take a lot more income to qualify for this monthly payment than this monthly payment. So let's talk about that now. How much income would it take to qualify for each of these scenarios? So I'll show you the number in 1 second, but real quick, let's talk about how lenders figure out whether you can qualify for a loan. And the way that they do that for conventional loans specifically, which we're looking at, is they look at your debt to income ratio, your DTI, your debt to income ratio. And this debt to income ratio is what the way they figure it out is they say your debt to income ratio needs to be less than 50% in order to qualify for the loan. So as long as you're less than 50% on your debt to income ratio for a conventional loan, then lenders will let you qualify for the loan. So what is your debt to income ratio? It is your total monthly debt divided by your gross monthly income. And your total monthly debts, to figure this top number out, they take this new proposed housing payment, the new housing payment you're applying for, you're trying to take on, and they add it to any other monthly debts that you have. Your credit card debt, student loan debt, car debt, any other monthly debts. They add that all together with your new housing payment. And then they divide it by your gross monthly income, which is your income before taxes. And this number needs to be less than 50%. If that is less than 50%, the lender will typically let you qualify for the loan. Now, a couple notes on this. One, if you are worried that I am advising you to let your housing payment come up to take on a mortgage of up to 50% of your gross monthly income, don't worry, I'm not. That's not what I'm saying here. I'm not giving you financial advice here on how much of your budget you should contribute to your housing payment. I'm just telling you what the lender will tell you in terms of qualifying. If you come to apply for a loan, here's what the lender will use to figure out whether you can take on the loan. That's how they figure it out. It needs to be no more than 50% of your gross monthly income, your total monthly debts. Second note is this number right here, your gross monthly income. If you make salary, then you're probably not even thinking through what that number looks like right now. If you're entirely salary or almost entirely, then you're probably not worried about that, and for good reason, because typically if you're mostly salary, if you're entirely salary or mostly salary, then whatever you're paid will just go down here. Whatever your monthly income is, your gross monthly income, then that will just be the number that they use down here. But if you make income in other ways, if you make income if you run your own business and you're self-employed, or if you work variable hours, one week you work 30 hours, the next week you work 50, the next week you work 60, the next week you work 20, and it just depends on the seasons and things like that. Or if you are in sales and you're paid mostly based on commission, then in any of those scenarios, this number is going to be not necessarily super straightforward in how the lender determines it. So this can sometimes be a limiting factor for you if that is the case. If you are salaried, then typically you'll just be able to use whatever you want to use down here. But if you are in any of those cases, any of those other situations that I described, then there are pretty rigid rules that lenders have to adhere to in how they figure out what this number is. It's things like using averages over your last 2 years. It's things like looking at your tax statements for the last couple of years. It just depends on what your pay structure is and what your work situation is exactly. But there are pretty rigid rules in how they figure it out. And so you can look into those if you want. Best way to figure out what this number is if you're in that situation is just to talk to a loan officer. Again, not advice, although I love hearing people's perspectives on what they use as far as, because it's just helpful to know in talking to clients what's common out there in terms of figuring out what kind of monthly payment are you comfortable with. Are you comfortable with up to 30% of your monthly income, up to 40%, maybe some people up to 50%, maybe some people no more than 20%. So let me know what the best approach is. I would be curious to hear your thoughts on that. But again, it's not advice, it's just how the lender figures it out. So if that's the case, then what is the number that's required? How much income do you have to be making in order to qualify for these two scenarios? Well, in the 10% down, if we use all of that $60,000 that we talked about and get to 10% down, then and assuming you have no other monthly debts, because if you had other monthly debts, we have to add that to this top number. But if we're assuming you have no other monthly debts, then it's going to be $6,830 per month. And let's see what that is per year. That is $81,960 per year. And so that's important because we talked about choosing between these two scenarios. If you just want the cash in your account, great. But the other important feature of that is maybe you and your spouse are applying for a loan, and you make all salary, but your spouse is entirely commission, and they just started this job recently, and not much of that income is going to be usable. Then the only income that's going to go down here is your income, your salary. Now again, I'm not saying commission isn't usable, it's just sometimes it's not. It has to meet certain standards. So maybe you're in a situation where only this one is usable, even though your household income is more than twice this. What that would mean is you might have to get to 10% down in order to get the payment down to here in order to qualify for the loan. Because if you're making $82,000 max, then you're not going to be able to qualify for this scenario. So let's see what the number is over here. It would be $7,416 per month, and per year $88,992. Yeah. $88,992 per year. So maybe you make $82,000 in salary and your spouse makes a good chunk of income too, so you have a good household income, but let's say the lender says, no, sorry, we can't use your spouse's income, or we can only use $3,000 of it, or whatever. Then you're maxing out around $85,000 and you're not going to be able to qualify for this loan. So that might be a scenario where you'd look at this and say, well, the cash would be nice to have, but in order to qualify for the loan, we have to get 10% down, so let's use all the cash. So that's one evaluation you might want to consider there. If you do want to get an actual quote on a house you're currently looking at, please do reach out. Or if you just want to get a look at your income and see how much of it would qualify, how much house you could qualify for. We do loans in Washington and Idaho, and we'd love to work with you. We love working with new clients. All our contact information is in the description below. My dad is our designated broker and our owner, and he's been doing this for almost 30 years and has a ton of experience and super knowledgeable in helping set clients up for success. And he's involved in every loan that comes to Cleveland Street. And you can check out what it's like to work with us. There's links in the description below to watch a video about our process, or just check out reviews from other clients. And if it looks like it'd be a good fit to work with us, we would love to work with you. So please do reach out using any of the contact information in the description below.